when we first explore investing. We often hear about many different types of funds. But to understand all of that, the most important thing is knowing what a fund actually is. A fund is simply a place where many people pool their money together. This pooled capital is then invested into various types of assets. It could be stocks, real estate, bonds, or many other diversified assets. Because of that, you don't have to pick each stock yourself or watch the market every day. Funds make investing much easier, even if you don't have deep financial knowledge. And this is a foundation you need before learning about the different kinds of funds coming next. An index fund is a type of fund that works by tracking a market index. These indexes can be the S&P 500, the NASDAQ 100, or many other major indexes. The fund doesn't try to predict or pick winning stocks. The fund doesn't try to predict or pick winning stocks. When the market rises, the fund rises. When the market falls, the fund falls too. It's an extremely simple model, yet remarkably effective over the long term. Because of its passive structure, an index fund is great for people seeking steady investing. And that's why index funds are becoming increasingly popular worldwide. The first advantage of an index fund is its extremely low cost. The first advantage of an index fund is its extremely low cost. The fund doesn't need a huge analyst team or constant trading, which keeps the cost extremely low. The second advantage is a very high level of diversification. Instead of picking a few stocks, you invest in hundreds or even thousands of companies at once. If one company struggles, the others help stabilize the entire portfolio. With this risk spreading, index funds suit people who want more stable and safer long-term growth. And that's why index funds are considered one of the best investment choices for most people. A mutual fund is a type of fund that is managed actively. The fund manager constantly analyzes and chooses when to buy or sell stocks. Their goal is to generate returns that outperform the overall market. But to achieve that, they need a large analyst team and complex strategies. That's why mutual funds usually come with significantly higher fees than index funds. Some funds perform very well, but many still fail to outperform a market. Mutual funds work best when you have strong confidence in the manager's abilities. But you should consider carefully, because high fees can erode your long-term returns. A hedge fund is a very different type of fund, usually reserved for high net worth investors. These funds use advanced and often complex investment strategies. They may use leveraged short selling or derivatives to maximize returns. But with that comes extremely high risk, making them unsuitable for most everyday investors. Hedge funds face fewer restrictions than traditional funds, giving them greater strategic flexibility. However, this flexibility also leads to more volatile and unpredictable returns. That's why hedge funds are only suitable for those willing to take on big risks for potentially high rewards. This is a playground for professional investors, not a safe choice for the majority. Hedge funds are well known for their signature fee model called 2 and 20. The first number, 2%, is the annual management fee you pay on your assets. This fee is charged regardless of whether the fund makes money or loses money. The second number, 20%, is the share of profits the fund takes when they generate returns. For example, if the fund earns a big profit, they keep 20% of that amount. This is a very expensive fee structure, suitable only for those willing to pay for the chance of high returns. But for everyday investors, these fees can significantly reduce long-term returns. That's why the 2 and 20 model makes hedge funds a space mainly for professional investors. An ETF is a special type of fund that combines the diversification of a fund with the flexibility of a stock.ors. You can buy and sell ETFs throughout the day, just like trading regular stocks. But inside every ETF is a pre-selected basket of diverse assets. This gives you high flexibility, while still maintaining the safety of diversification. ETF management fees are usually very low, similar to index funds. This makes ETFs attractive to both new investors and experienced ones. You can access multiple markets with just a single ETF ticker. This flexibility, diversification, and low cost have made ETFs explode in popularity as a modern investment trend. So, which type of fund is the most suitable for you? For most everyday investors, index funds and ETFs are usually the best choices. They're simple, low cost, and deliver stable long-term performance. Mutual funds work best when you genuinely believe in the manager's ability. Meanwhile, hedge funds are designed for professional investors who can handle high risk. Each option has its strengths and weaknesses, depending on your financial goals. What matters is knowing what you want and how much risk you can handle. This isn't financial advice. Always think carefully before making any investment decisions.